Did you know that 90% of day traders lose money? Or that over 80% of professional fund managers fail to beat the market? Shocking, right? Despite all the hype around quick gains and smart trading strategies, most people are investing wrong. But how do you know if you're one of them? The truth is, most people don't even realize the mistakes they're making. They think they're making smart choices until the market turns and their portfolio shrinks. In this video, we'll break down common traps like chasing quick wins, falling for FOMO, and thinking cheap stocks are the best deals. You'll learn how to spot the difference between true value and just a bargain, how to avoid following the crowd, and why time is more important than timing when it comes to investing. Stay tuned for shocking facts, useful strategies, and expert tips that can help you take control of your investments. Are you ready to find out if you're investing wrong? Let's dive in. Chapter 1. The illusion of quick wins. Are you falling for instant gratification? Many investors make the mistake of seeking instant returns. The problem with this mindset is simple. Investing is not a sprint, it's a marathon. In a world of overnight success stories, it's easy to get lured by the idea that you can make quick money in the stock market. But research shows that 90% of day traders lose money over the long term. If you're always looking for fast wins, you're setting yourself up for disappointment. The key to value investing is patience. Legendary investor Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." The real power of investing lies in time, not timing. A 2022 study by Morningstar found that investors who stuck with their investments for 20 years outperformed those who jumped in and out of the market. Consider Apple. The company has seen its ups and downs, but those who held onto their stock for the long haul reaped massive rewards. The value investor knows that good businesses only get better over time, and their stock prices will reflect that. Chasing quick wins often leads to impulsive decisions. For example, did you know that the average investor underperforms the market by 1.5% annually, according to a study by Dalbar? The reason? They sell at the wrong time, usually out of fear, and miss the big returns. So, if you're always reacting to the latest news, you might be unknowingly sabotaging your own success. Instead of focusing on instant gratification, focus on identifying high-quality companies at reasonable prices. Remember, the goal is to buy undervalued stocks and let them grow steadily. This is the secret sauce for long-term wealth. Chapter 2. The FOMO Trap. How emotional decisions are stealing your wealth. FOMO, or fear of missing out, is one of the strongest emotional forces in investing. When everyone's talking about a hot stock, it can be hard to resist jumping in. The problem is, FOMO makes you react impulsively, often at the worst possible moment. Take the dot-com bubble, for instance. In the late 1990s, people rushed to invest in tech stocks, even though many were overvalued. By 2002, many of those same stocks had lost 80% of their value. A 2019 study from the University of California found that investors who succumb to FOMO often overpay for stocks. They're buying at the peak, not when the stock is undervalued. When emotions drive your decisions, it's easy to forget the fundamental rules of investing: buy low, sell high. Here's an interesting fact. In 2021, Bitcoin saw a dramatic rise, only to crash soon after. FOMO drove many people to jump in at its highest point. A smart value investor, however, would wait for signs of undervaluation before making any moves. The key to avoiding FOMO is to stick to your strategy and do your homework. Legendary investors like Charlie Munger and Buffett don't buy based on hype. They buy based on research, fundamentals, and value. The market may be loud, but a good investor knows how to tune out the noise. And remember, just because everyone is talking about a stock doesn't mean it's a good investment. In fact, being part of the crowd often means you're late to the party. Always do your own research. Chapter 3. Cheap versus value. Is bargain really the best deal? Many beginners confuse cheap with value. But just because a stock has a low price doesn't mean it's a good investment. Value investing is about buying a stock at a discount to its true worth, not just picking up cheap stocks. Warren Buffett said, "Price is what you pay, value is what you get." It's about understanding the company's fundamentals, not just the price tag. Let's talk numbers. In 2021, The S&P 500's average price to earnings (P/E) ratio was 35, much higher than the historical average of 15. Stocks at this high of a P/E ratio may be expensive, even if they seem cheap in price. To make wise decisions, you need to look beyond the price and dive deep into a company's earnings, debt, and growth potential. Take Ford Motor Company in 2009, for example. It was dirt cheap, but it was also struggling. Many investors assumed it was a bargain, but they missed the fact that it had long-term issues. Buying cheap stocks without understanding the business can be a dangerous game. A real value stock, on the other hand, is one that's undervalued compared to its potential future earnings. This might mean paying a little more upfront for a high-quality company with strong growth prospects. It's not about being cheap, it's about being smart with your money. So, before buying a stock, ask yourself, is this a true value opportunity, or am I just getting a bargain? If you're enjoying these tips and want more ways to protect your investments, don't forget to subscribe to the channel. You won't want to miss what's coming up next. Chapter 4. The Dangers of Herd Mentality. Why following the crowd is a recipe for disaster. Following the crowd can feel safe, but it's usually the wrong move in investing. Herd mentality leads people to invest in things that seem popular without considering the underlying value. It's the same reason people rush to buy the hottest new tech stock without understanding its fundamentals. Research from the University of Michigan found that individuals are far more likely to make bad investment decisions when they follow the herd. In fact, the study showed that the stock market experiences higher volatility when there's a surge in popularity surrounding a stock. During the 2008 financial crisis, many investors followed the herd, buying real estate and mortgage-backed securities without understanding the risks. By the time the bubble burst, millions lost everything. This is why value investors are contrarians at heart. They believe in doing the opposite of what the crowd does. When everyone is buying, that's often a signal to sell. When everyone is selling, that's often the time to buy. Think about it. When a stock becomes popular, it's often too late to get in at a good price. Instead of following the crowd, look for stocks that are undervalued but not yet discovered by the masses. It's those hidden gems that offer the real potential for growth. Chapter 5. The Danger of Overconfidence. Are you misreading the market? Overconfidence can be just as dangerous as fear. Many investors believe they can beat the market or predict stock movements. But history shows that most investors, even professionals, struggle to do so. In fact, a study from the CFA Institute revealed that 85% of mutual fund managers underperform the market over time. It's easy to think you've cracked the code, but the market is unpredictable. One wrong move can wipe out years of gains. Overconfidence often leads to taking unnecessary risks, like investing too much in one stock or sector. Remember, diversification is key to reducing risk. Warren Buffett famously said, "Risk comes from not knowing what you're doing." It's crucial to know when to hold back and resist the urge to chase after risky investments. If you've been successful with a few picks, don't get complacent. Keep learning, stay humble, and always be ready to reevaluate your strategy. A good investor understands their own limits. They know that they can't predict everything, and they prepare for the unexpected. Overconfidence often blinds people to warning signs, so always check yourself before making big decisions. Chapter 6. The Long Game. Why timing is more powerful than timing the market. The myth of timing the market is one of the biggest mistakes investors make. In reality, trying to time the market rarely works out. A study from JP Morgan showed that if you missed just the best 10 days of the market over the past 20 years, your returns would have been halved. The market rewards patience, not quick reactions. Buffett always emphasizes the importance of time in over timing. He famously said, "Our favorite holding period is forever." When you invest in solid companies at reasonable prices, the passage of time does the heavy lifting. Take Coca-Cola, for instance. Its stock price has seen slow but steady growth for decades. Those who held onto their shares through the ups and downs are now reaping the rewards. The key is to focus on buying companies that will grow over time and then letting them do their thing. Studies also show that long-term investors significantly outperform short-term traders. According to a study by Dalbar, Long-term investors outperform traders by an average of 3.5% annually over 30 years. The reason is simple. Those who stay invested through market volatility tend to come out on top. Time is your best ally in investing. The longer you hold on to quality stocks, the more likely you are to see significant returns. So, forget about trying to predict the next market move and focus on building a solid portfolio that will grow with time. If you've made it this far, make sure to hit the subscribe button for more valuable investing insights. Don't miss out on learning how to grow your wealth smartly.